The Republican Congress has passed a bill that repeals or changes key aspects of the Dodd Frank Act. That might sound familiar, but rewind a couple years to get the context. A signature law of the Obama administration. It cracked down on risky lending and investment, all done by banks that helped cause the 2008 financial crisis. It put tough regulations and reporting requirements on every bank with more than $50 billion in assets. But this new law places those conditions only on banks worth less than that, worth $250 billion. Worth more, rather. That means it applies only to 9 U.S. lenders. Here's what Democratic Congresswoman Maxine Waters had to say about that change.
These banks are just greedy. They will never get enough. They want to do away with Dodd Frank because Dodd Frank is protecting consumers from their fraud. Look how much money they're making. All they will tell you, this is all about community banks. But let me just tell you that community banks, credit unions, and the economy are doing great with Dodd Frank reforms in place.
All right, in New York, former investment banker and economic analyst Charles Ortel with us. Charles, let me just begin with your reaction to Maxine Waters.
Well, I think Maxine Waters knows less about economics than I know about ballet, and I don't know much about ballet. I think the Dodd-Frank legislation was something that was done in the aftermath of one of the greatest recent financial debacles of all time, but it didn't really address the root cause of the problem. With interest rates really low, and with it very difficult in this country to create new jobs, the regulations on employers for creating new jobs are onerous. You have a condition here where home prices are very, very high, higher than they should be, and regulators and legislators are putting pressure on banks to induce borrowers to make risky loans at the top of the housing market once again. So I think these moves, I don't know every aspect of all the regulatory changes, but I think it's a good thing to curb the power of this out-of-control consumer protection agency, which has no effective regulator of it, and place the marketplace back in a normal zone. Raise interest rates some, encourage employers to hire people, let housing prices come down, and then have people buy homes with a reasonable deposit, not 5%, not 3%, but 20, 25%.
Charles, with all due respect, Dodd-Frank was put in because people said we had a situation where banks were too big to these banks were too big to fail. We needed more stringent reporting requirements. Now, banks are doing okay. Yes, they have to fill out a few extra forms, but the banking sector is doing okay. Why? So why should the government backtrack on something that's worked since 2008 to prevent more disasters?
Well, again, with all due respect to you, I think what's worked since 2008, what has optically worked, is keeping interest rates on the floor. They're still way under where they were from 1965, that is to say the 10-year rate, the key benchmark risk-free rate, 1965 to 2007. We're still well under that. We're about 50% of the average. In that environment, anybody who's in the business of taking deposits and not paying interest on them and making loans is going to produce decent reported earnings. That's not the issue. The issue is encouraging jobs and employment to come back to this country in an environment where interest rates are higher than inflation. That's what we need to see in this country. Dodd-Frank did nothing to help that, and I don't think it went far enough to discipline the speculative behavior that you still see today in banks, even under Dodd-Frank.
Charles, well, if we're talking about that behavior that you still see today, and then you rewind to think about everything that Trump promised, he said the banks were getting away with murder. He vowed to break up the big banks and force them to pay higher taxes. Explain this sort of 101 to the viewer who's watching and says, well, how does this fulfill any of that?
Well, I think what this did is to recognize that on global scale, a bank that has $250 billion in assets is actually not that big on global scale. You can't just look at the U.S. Most of our banks operate around the world, right? So when you're down at $50 billion, it sounds like a big number, but it's not actually that big. So to free up those banks from the undue regulatory burdens, and if you talk to bankers and understand the degree to which bureaucracies have been fed by Dodd-Frank, you'll see that this is, I think, a step in the right direction. Is it perfect? Of course not.
Well, again, Charles, just briefly, you talk about creating jobs and other things. That's not what Dodd-Frank was created to do. It was just created to police the banks more. It wasn't created to do some of these other goals you're setting for it.
Again, I don't think I think the aim of the legislation is fraud. It's like, you know, trying to work after the crimes have committed. We have a situation in this country, I'll grant you, where interest rates, for example, on credit cards are still extraordinarily high. Mind you, that interest is not deductible. Why does that make any sense? You know, why does it make sense to have people taking out credit card debt at 20, 25, 40% interest rates when depositors are getting 2%? You know, there's something clearly wrong with that. And why is that going on? Because there's such undue pressure on incomes in this country that people are willing to shoulder more credit card debt than they should. To address this problem, you have to go to its root cause.
Charles Ortel in New York.